Hi there. If you are tuning into this podcast, it means one of two things. Either you have no clue about managing your finances or you want to take them to the next level. Either way, we've got you covered. Financially Ever After is for the modern day Indian professional who is ready to take control of their financial journey. So let's start building your financial future one episode at a time. Welcome to Financially Ever After. And now we can get into the session for today, which is how to select mutual funds. But before we dive in, a quick disclaimer. So, firstly, we're not promoting any specific platform or fund, and we are not being sponsored by anyone. These are Ankit's independent views, and we just want to help you make informed decisions. So, we're not trying to sell you anything basically. So, with that, let's get started. We are assuming you already know what mutual funds are because we're not going to talk about what they are and what are the different types. In case you want us to do a session on this, you can DM Ankit or me and let us know. But today we'll start with some basics, help you understand what you should know or do before you start investing in mutual funds. We'll share some common mistakes investors make, along with 5 essential aspects to look at when you're selecting your mutual fund. And finally, we'll end the talk with few practical tips that Ankit himself uses when he is selecting funds for our clients. So, yeah, a lot of knowledge packed in this session. Ankit, over to you.
Sure, thank you, Meeta. So, guys, we are starting with this, and for about 5 minutes, it will be somewhat basic. People who are already experienced, you may maybe skip this part. So, when you're beginning any investment, be it in mutual fund or anything else, there are few things that you first of all need to understand. This is something I have said repeatedly. Is first thing is your understanding your financial goal. What is it that you want to achieve financially speaking? So, what is the event? Getting married, buying a house, or whatever. What is the amount that you need, and how much time you have. Next, very important thing is to understand your risk appetite. Okay, how much risk you will be comfortable taking as an investor. And a common mistake here is that people think that whatever general, how they have been dealing with stuff in their daily life is something that determines how they will be also, as an investor, which is not true. So there are a number of resources online. You can just look things up, and then you will be able to find the number of ways you can check your risk profile. We also have a tool. It's a free tool. You can go to our website and use Riskometer to find it. Now, once you have these two things sorted, this will help you in determining how the asset allocation should look like. What is asset allocation? How is it that you're dividing your entire investments across various asset classes? Okay, so asset classes are equity, debt, gold, and among others. These are the key asset classes that most people invest in. Now, when we are selecting mutual fund, there are a few factors that you should be looking at. First and foremost is performance. Any actively managed fund, actively managed is someone wherein a set of people, investment managers, they're doing their research and finding which stock to buy, which investment to buy, at what price, when to buy, when to sell. Okay, and any actively managed fund that you have been investing in, it should be beating its benchmark and ideally be a top ranked in its category. Also, it is important to check the performance for appropriate tenure. What does that mean? When you're investing in equities, you should be looking at relatively longer term performance. There is no point just looking at the performance for a fund for 3 months, 6 months, 1 year when we are talking about equities, because there will be movement in the market. Ideally, you should be looking at something like 5 years, 7 years, 10 years, how this fund has performed, how the ranking has been. Another very important thing is to check the consistency of these returns. It may just be the case that in one of the periods, the rank for the fund was, say, second. In the other one, so out of 10, it was second. And in other one, it was, say, 8th. Next one, 5. And the next one is, say, 10. This is not somewhere you should be investing, even though it may also be, it may be the first or the top ranked category right now. Okay, consistency is very important.
Okay. Ankit, I don't understand what you meant by beat the benchmark. So what do you mean by that?
Sure. So every fund has a benchmark. So suppose if you're investing in large cap funds, large cap fund is a fund that invests in top 100 companies of India. Now there are indices, just like Sensex. Sensex is comprises of top 30 companies of India. Similarly, there are indices. Nifty 100 is what tracks the top 100 companies of India. the large cap fund that you're investing in, it should be beating Nifty 100. That is what beating the benchmark is.
Understood. So it should be doing better than the index.
That's right.
Sorry. Yeah.
That's right.
Okay.
Okay. So this is extremely important. And so when beating the benchmark and the tenure. Now we have developed a tool called Portfolio Analyzer. It's live on our website. You can just go over there if you already have an existing portfolio and you want to check if the portfolio has been performing well or not. You can just go to our website, log in using your phone and OTP, and you can just upload your CAS, combined account statement, that you get in your email every month. Put in the password, which is your PAN, and in like roughly 30 seconds or so, you'll get a detailed analysis of how your portfolio has been performing. Now, the next item is next factor to look at is expense ratio. This is essentially the fees that you're being charged by the the investment manager for managing your funds. Now, you should check that the fees that you're paying should not be too high on your investments, but you should also be aware that lower is not.
Ankit, your voice is breaking.
Like if you are, going to say a doctor.
Ankit, your voice.
Can you hear me now?
Not really. Can you say something?
Okay. Yes. Is it better now?
Yeah. So I heard that expense ratio is something we should look at, and lower expense ratio always is not a good thing. That's the last thing I heard.
That's right. So it's not always best that you should be choosing a fund just based on the expense ratio. Okay, because think about it. Like if you're going to a doctor, you will not go to a doctor which charges you the least amount of fees. You would like to go for a doctor which gives you the best result. So instead of focusing on the expense ratio, what you should actually be focusing on is the net return. Net return means return after accounting for the fees that you were charged.
Okay. Understood. Yeah.
This fund size. So fund size, by fund size I mean the amount of asset that is there in this fund. Ideally, you should not be investing.
Ankit, can't hear you again.
Crore in size, because it's too small. It can be too risky, as well as amount of. Hello, can you hear me?
I think there was a lag, but I think you'll have to repeat.
Can you hear me?
Yeah, you'll have to repeat fund size again. Is this what you mean by AUM, assets under management?
Yes, that's right. So fund size is total assets, or AUM, the amount of assets that are there with a mutual fund. Now, if the total size is less than 1,000 crore, try to avoid it, because this may not be a very stable fund. And the other thing is the expenses may also be high. Okay, so that is one side, but also that it shouldn't be the case that you're going for the largest fund, because if the funds are very big, they may face challenges in finding opportunities to deploy all of the funds, and it will take a hit on the returns that they generate.
Right.
Okay.
So is there like a range
the next one is
that you would? Is there a range that you would suggest, or it's very depends from category to category?
It actually depends from category to category, and also whether it is an actively managed fund or passively managed fund.
Okay.
Okay, it's more relevant for the actively managed funds.
Okay.
Yeah. Okay, the next one is turnover ratio. Turnover ratio means how many times, so essentially, so if a fund is there that is buying and selling a lot of the investments that it has made, okay, that is not a good sign. It shows that the investors, the investment management team, they don't know what they're doing. They're incurring extra costs because with every trade, they have to pay certain fees, certain taxes, like stamp duty and stuff. So it is going to take a hit on your return. So lower the better. And lower the better, just be aware that you should be comparing it in the category of the fund, not across just any random fund. Okay. And the next one, very importantly, is how stable the investment management team is. If you see that the people who are managing your money, they have not been working at the fund for a long time, and there is a high attrition, people keep coming and going, it shows that it will be unlikely that you will be able to get a consistent return from these guys. Okay, so these are the main few main factors that you should be looking at. Few other factors that you should be aware of is the exit load. Essentially, this is the penalty for exiting the investment too early. Okay, now this too early can be differs from company from fund to fund. It may be 0 days, it may be 1 year. Okay, so you should be aware of what the number is. The other one is growth versus IDCW. Growth means whatever investments, whatever return, dividend and stuff that the mutual fund has received from the investments, it gets reinvested. So the NAV of your investment will keep going up. IDCW stands for income distribution and capital withdrawal. What that means is at regular interval, the fund will be distributing some funds to the investor. Okay, now this is not the best way to go about it, particularly, and it also depends on who you are. If you are, earning actively and you're putting more money in investments, you should go for growth category. Okay, and compared to someone who is in, trying to sort of live on their investments in their retired age, they can choose IDCW, but there are other ways like systematic withdrawal plan, which may be more tax efficient for you. So that is also something that you should be aware of. Now, this brings me to the tax efficiency. When you are buying and selling your investments, you should also see what is the tax liability that you're generating. Okay, because every time you are booking a capital gain is essentially profit on your investment, there is a tax liability. Because you should be aware about how to optimize that. Active versus passive is the next one. Active is where, as I mentioned, is where the investment management team is actively selecting funds, and passive is one wherein they are just replicating index. Now, there has been a lot of noise around, how passive is better. It has got lower expense ratio, so you should go for passive. But this is something that has picked up a lot in the US, and it makes sense over there because US market is much more mature. Indian stock market is not that mature. Indian market does not have as many players. What's actually happening is various size of funds, based on the kind of investment that they're making in equities. So large cap, that is for first the top 100 companies of India. Next one is mid cap, which is for rank 101 to 250. Small cap, 251 to 500, and everything after that is micro cap. Now, with large cap, the information that is being shared, the amount of people who are investing in it, Indian and as well as foreign investors, is becoming very high, and the chances of actually generating better return than index in large cap is increasingly vanishing. Okay, so and my expectation is that in 1 to 2 years' time, investing in an active large cap fund will not make a lot of sense. Okay, but when it comes to mid cap, small cap, and micro cap, those categories are still not well researched and well covered. There are not as many investors in there, and that's why investing in a passive fund in these categories does not make sense as of now in India. Okay, apart from this, you should also be aware when you're investing in mutual funds that you need to monitor your funds regularly, okay, and rebalance it time to time. It's not one of those you can just buy it and forget it. Okay, it needs to be monitored regularly. Again, the portfolio analyzer tool that we have built that can be very helpful in monitoring your the performance of your funds, all your funds, wherever you have invested it from, and it just gives you an update about what's happening, if there are any changes that are needed. Now, these are the factors that you should be looking at. Now,
Ankit, can you just give a quick roundup because you gave so much gyan in such short amount of time? Can you quickly go over what were those 5 factors, just the headings,
Sure.
and then what were the additional factors?
Sure. So the key factors that you should be looking at when selecting a mutual fund is the performance. That includes the tenure and the consistency. Next one is expense ratio, the fees that you are being charged. Fund size, that's the total amount of asset and AUM with a company, with a fund. Turnover ratio is how quickly is the shares, the investments are being turned, bought and sold in the fund. And what is the stability of the investment management team? These are the key factors that you should be looking at. Additional factors that you should be aware of is the exit load, growth versus IDCW. Younger people should be going for growth funds. Tax efficiency whenever you are booking some profit, whenever you're selling your investment. Active versus passive. Passive is not always the best. and monitoring your funds regularly and rebalancing it from time to time.
Awesome.
Okay, all of these things can be captured and looked at using our tool, Portfolio Analyzer, which is available on our website for free. Okay, now moving on, how do you actually do it? Now, doing all of these things is actually a lot of work, and a lot of our clients, they are very busy professionals to do it themselves. So this is how I do it to help them build a portfolio aligned to their own needs. So I go to mymoneycontrol.com, and again, repeating the disclaimer, we are not promoting Money Control. This is not a sponsored session by them. You can choose any platform of your choice for selecting mutual funds. Now, I use Money Control, so that is what I'm going to talk about. So go to moneycontrol.com, and then you'll see that there will be an option for mutual funds, and under that drop down, you can click on Find Funds. Find Funds. Over there, you can use filter to select the right category, whether you want to invest in large cap equities or long-term debt. You can just select it from there so that it will show all the funds that are there in this category. From here, you will notice that there are multiple tabs that talks about return, risk, portfolio, NAV, and whatnot. So, you can select and go through each of these to say what is relevant for you, what makes sense. You will need to go through a few of them based on the factors that we had talked about. You have an option of sorting the list on various columns. So, like suppose again, if I'm talking about investing in equity, say large cap funds, I can sort it by say 5 years, 7 years performance to see who has performed the best. Okay, again, now over there, you need to look at the consistency of these returns. Okay, and with this, which if you have found, okay, this is a fund that is looking good, you can open it, click on it, it will open the details of the fund, and over there you will be able to see, among other things, the rank of this fund in the category. Now, with that, it's like you can see, as I mentioned earlier, it should be consistent performer. It should ideally be in the top performer consistently for the periods that are relevant for this fund. Okay, I hope that is helpful, and it should make it easy for you to select the funds.
So we're not taking questions in today's session, but we'll be doing a Q&A with our community on WhatsApp on Thursday. So for all of you, if you have any questions on what we shared so far, then just have them in the back of your mind and you can ask them on the group on Thursday. Meanwhile, there are a few FAQs that tend to come up with our clients and in my conversations. Also, a couple of things that I see influencers talk about, which is absolutely wrong, I think. So we want to clear the air on those topics as well. So very quickly, Ankit, this is kind of like rapid fire. I will, give you the question and you can, kind of give your answer in like a very concise manner so we can wrap it up quickly. Okay, so one thing is that I heard an influencer, not going to take any names, say that you should only invest in equity mutual funds because if you want to invest in debt, you have national savings certificates, FDs, PPF, all of that. So what are your thoughts on that?
See, there are many times people don't even know about debt investments. It's very crucial. And the other options, that you was talking about, PPF and NSC and stuff, the rates are high right now because the interest rate is high in the economy. That will not always be the case. As of now, as I mentioned earlier, FD rates are actually high, and if you can actually book some FD right now to lock in good rates, but that is not something that will keep continuing. And generally speaking, the rates, the return that you get from debt funds, that is going to be higher for most of the funds, higher than what you get for fixed deposit or even NSC, PPF and stuff. Okay, and in addition to that, they also offer you liquidity, which a lot of these investments don't.
Okay, so you're saying definitely have some allocation towards debt mutual funds in your portfolio.
Absolutely.
Okay.
Critically important.
Okay. What are your thoughts on thematic or sector specific funds?
Sure. So this is something that we have talked about earlier as well in our community as well as on our previous post. These are highly risky funds. If you are someone who can identify a theme, okay, that would run pretty well for like say next 2-3 years, you can invest in that. But it's also very important that you are in a position to understand when to exit them. If you can do that, you can make great returns. If not, stay away from them. Stay away from them.
Okay. Next, a lot of people, tend to invest in way too many mutual funds. So, if you can just clarify, okay, so how many mutual funds should I be investing in, like in my portfolio? And does this depend on anything like the size of my portfolio, for example?
Yes, absolutely. So, size of your portfolio is one of the very important things. I have seen a number of our clients, who are using this portfolio analyzer, that they have 38 funds, 56 funds. It just doesn't make any sense. 10 to 15 funds is good enough even for a big size portfolio. If you have anything, if the size of your portfolio is anything below 10, you should not be having more than 10 funds. By 10, I mean 10 lakhs. If the size of your portfolio is below 10 lakhs, there is no reason for you to have more than 10 funds in your portfolio. As the portfolio size grows, you can diversify a little bit, but it shouldn't be the case that you are buying two separate funds, but essentially they are doing the same thing, investing in similar assets, and maybe even the investments are overlapping.
Okay. Can you talk about NFOs, which are new fund offering? So this is like in IPO you have like initial public offering, which is for stocks, and then in the mutual fund world there's NFO. So is it good to invest in NFOs?
Okay, with NFO, they are the new funds that are coming up. They are raising money for the first time. Just like IPOs, for companies, there are good companies to invest in, there are bad companies to invest in. When someone is doing an IPO, they give you the historical financials. I mean, the share price is not available historically, but their performance is still available. With NFO, for mutual funds, you don't have any background of this, how this can possibly perform. And that's why no return data, none of that sort. So if you are looking at investing in NFO, you need to do research with a lot of subjective items, which is more difficult. And if you're not particularly experienced, I would recommend staying away from NFOs. There are so many funds out there that you should definitely try, unless and until a fund is offering something truly unique, which is becoming increasingly more difficult. But if a fund is coming which is offering something very unique, consider talking to an expert and get the views then, and then move forward from there.
Okay. Next, second last question, just one more after this. We get this a lot, when do you quit your mutual fund? So when do you actually stop your investments?
Sure. First is, couple of options. First of all, if you have met your financial goals, you can, sell your investments. Second is the portfolio rebalancing that you need to do. There will be times, when you will need to adjust. I'm not going to get into what is portfolio rebalancing, but there'll be times when you need to rebalance your portfolio. That means selling some funds from here and buying some other funds. Okay, that is another one. And specifically from the perspective of a fund and its performance, look at if the performance has been going down. If that is the case, give it some time, don't panic. Like, for example, equity funds. I'm focusing more on equity funds because a lot of people invest, are focused on equity funds.
Mm-hmm.
Suppose a fund has been performing exceptionally well for 5 years, 7 years, 10 years, but it has started, underperforming for say last 3 years or 3 months or 6 months. Now, 3 months or 6 months is not something you should be, basing your decision on when it comes to equity funds. But if the underperformance has continued for say 1 year or 2 years, it is time to get out.
Okay. And final question, can you talk about dollar cost averaging? Because this is something that, has come up in various conversations, and people are doing their SIPs, but then, they wonder if the market is high, should I stop them and stuff. So if you can just talk about, what this is.
Sure. Dollar cost averaging is essentially putting in the SIP part, you're putting some fixed amount of money every month in a specific investment. So suppose you were putting in 100 rupees in a specific fund, and say the NAV or the price of it is 10 rupees. You will be able to get 10 units of it. Next month, gone up. It has gone up, and say it is 20 rupees. Well, of course, there's exceptions. I mean, just for the purpose of the discussion, you will only be able to buy 5 units of it using the same 100 rupees. Okay, but when the price has come down to 5 rupees, you'll be able to buy 20 of them. So this helps you in the same amount of money you are able to buy investment which are cheaper when they are cheaper at a lot more of these investments when they're cheaper, and when they're expensive you buy only a few of them. Okay, so overall the cost of your investment comes down. Okay, and SIP is something that you should keep continuing.
Right.
Just because the market is up or down, you shouldn't be worried about it. And anyways, you're a long-term investor. You shouldn't worry too much about how the market is moving.
Okay. So one bonus question, because it's related to what you just said. So what if I have a lump sum amount, right? How do I invest that? Like a lot of people have money lying in their bank account and they want to deploy it. So what is the best way to do that?
Sure. So if the lump sum amount is a big amount, what you should be doing is that first of all, have your allocation in place. And then when it comes to the debt funds and stuff, you can make the payment right away, just lump sum for the entire amount in the debt funds. When it comes to equity funds, which are like more volatile, if the amount is big, you shouldn't invest all of it together. What you should do is that divide it in 3 parts or 6 parts based on how much the amount is, and do a systematic transfer plan. What that means is today you are putting that money in a sort of a liquid fund, and every month, just like SIP, a fixed amount will keep getting transferred from these liquid funds to the proper fund, proper equity fund that you have selected.
I understand. So basically your money is still growing in a liquid fund, but then you're also deploying it systematically through your SIP.
Exactly.
Perfect. So thanks everyone who joined in for listening. Everyone who's part of the WhatsApp group, we're going to have a Q&A on Thursday evening. So you can ask your questions there. Also, a recording of today's session as well as the financial summary part is going to be available on Spotify. So we'll share those links with you. I hope this was useful. We try to keep it really short so that you're not bored and it's going on and on. And we'll be doing this every week, so we hope that we'll see you weekly. Thank you so much for being here. Have a great evening.
Thanks everyone. Thank you, Meena.
Thanks, Ankit. Bye bye. Good night.